Thank you very much, and good morning to everyone, or good afternoon, or good evening, depending where you are. I'm coming to you from South Australia, so it's evening where I am, but I think a little bit earlier for most of you. Thanks for making time to join today. We've actually presented a version of this presentation in the past, but there have been a couple of changes recently, and it seemed like a good time to update it and just to kind of bring in those who might not have had the opportunity to catch it the last time it was done. Shireen mentioned the purpose of the session is to talk about EIS and SEIS. We'll get into the differences between them, why there are these two separate regimes with very similar names and some similar advantages. And we'll look at, I guess, some of the key advantages and the qualifying criteria and well, perhaps some pitfalls to avoid that we have seen coming up with clients in the past. So let's dive in. If there are any questions, please feel free to raise a hand or drop a question into the chat, and we'll try and wrap them up at the end. Or I'm happy to take them as we go through. So please just feel free. So let's dive in. First of all, why are there these two schemes, and what really is all the fuss about? Well, in a nutshell, they are schemes that were implemented in order to provide tax advantages for individual investors, UK resident individual investors, that incentivize people to invest in early stage businesses that might otherwise be seen as a little bit on the risky side. So the key advantages for investors are a very generous income tax relief. There's a 30% rebate effectively on the amount invested in an EIS investment, and a 50% rebate on the amount that's invested in SEIS. SEIS, by the way, to get into the acronyms, Enterprise Investment Scheme and Seed Enterprise Investment Scheme. The headline tax advantage is that income tax saving. There are a number of other tax advantages, however, that are, I guess, often overlooked, but that can be quite important depending on an individual's circumstances, and that can bring the downside protection on these investments up to, effectively 86.5%, which really de-risks what would otherwise be potentially quite risky early stage investments. So for issuers of equity that falls into these classes, if you're prepared to go through the motions to get equity that qualifies, it provides a potentially very valuable access to a pool of liquidity. It's great from an investor relations perspective to be able to offer these advantages to your investors, and the limit on availability, I guess, which we'll get into the restrictions on this, but can in some cases drive a bit of competition and stronger terms among investors. But historically, EIS has been around for quite a while now, 30 years. Implemented initially in 1994, it replaced something called I have to go back to my notes here, the Business Expansion Scheme, which I know absolutely nothing about because I was 12 years old when it was got rid of. But the EIS has been around for quite a long time. I wasn't so interested in tax law in 1994 as I am today. The amounts raised are shown here. There's a kind of an interesting trend there. Obviously, we've seen quite strong growth over the lifetime of the scheme. It's quite interesting to note that the dark blue bars on that bottom graph represent rounds that have been raised by companies that have already raised equity. So the green is new companies raising for the first time, and the blue is the subsequent rounds. Interesting to see that although the total amount raised has been reasonably steady at about that £2 billion per year mark, it's really dropped off among first-time raisers, and not clear to me why that is, but an interesting trend nonetheless. So the scheme was implemented, as I said, to allow companies access to a pool of liquidity in a tax-favored environment. Some stats on the left there, you can see, this has been quite a popular scheme. More than £20 billion has been raised over the life of the scheme. I don't have more recent stats than 2020, I'm afraid, but over 30,000 companies have taken advantage of it. And the average size of those rounds is about £400,000 to £500,000. So you'll see 3,700 companies raising that 1.7 billion in 2020 to 21. And about half of them, almost exactly half of rounds are raised by companies doing so for the first time. But as we see, that trend has dropped off a little bit. The Seed Enterprise Investment Scheme is a lot newer, only introduced in 2012, really as a way to drive that liquidity even earlier in the investment cycle. So as you'll see, it's targeting smaller and earlier stage businesses. Typically, rounds are a little bit smaller there, about £100,000. But it's been nonetheless pretty popular, raising almost 1.5 billion over the first 8 years of its life cycle. And as I said, that's almost certainly been exceeded in the last 3 or 4 years since these stats were last published. So what are the tax benefits for investors? Well, I mentioned them at the top of the call, but getting into them in a little more detail. Income tax relief is really the headline there. You can see 30% for EIS and 50% for SEIS, and we'll have a worked example just to talk through what that means in numerical terms in a moment. EIS also offers a deferral of capital gains. So what does that mean? It means if I sell an asset today and I realize £100,000 of capital gains that would otherwise be taxable, but I choose to put that £100,000 in this tax year into EIS qualifying shares, then I get complete deferral of that. I don't pay any capital gains tax this year. If I hold the EIS shares for, let's say, 5 years, then we revive the gain at that point and it's taxable then. So it's not an exemption, but it's quite an attractive cash flow benefit, let's say. SEIS does not have that deferral, but it has something else. It has a reinvestment relief where 50% of the amount of the gain that's reinvested is actually fully exempted. So again, take that same example. If I make £100,000 of gain today and put it into SEIS shares, then I get a relief from capital gains tax on half of my gain. So I only pay capital gains tax on the remaining £50,000 this tax year. And there's no revival of the rest. That is a true exemption on that 50%. Loss relief. So again, we're talking about reasonably early stage businesses. The reality, sadly, is that not all of these investments will be successful. HMRC is generous again with the way that losses are allowed to be treated, and they're allowed to be set off against ordinary income rather than capital gains. Ordinary income obviously taxable at higher rates, up to 45% rather than 20 or in some cases 28% for gains. And most, I mean, it's a broad generalization, but most people will have income against which they can set losses. Not everyone will have capital gains and that they can set capital losses. So again, can be attractive in a downside scenario, and again limits the downside exposure that investors face. There is a complete exemption from capital gains tax on the sale of shares that qualify for EIS or SEIS. So again, you invest in a company that does a 10x, 100x, 1000x. You invest, you got into Facebook's SEIS round. If they had one and made 1,000 times your money, you pay no tax when you sell those shares, regardless of what level of profitability you make, as long as you hold them for at least 3 years, and as long as the various qualifying criteria continue to be met during that period. And then there is an exemption from inheritance tax as well, which I guess attaches to various classes of shares, but in particular, SEIS and EIS shares automatically qualify for that under business property relief. So, one of those somber things we need to think about, but for those who are looking at estate planning, it is something to consider as well. So, worked example, just some very simple numbers just to kind of illustrate that. We have a 45% taxpayer who's made capital gains of £100,000 from the sale of a holiday home. I use a holiday home because real estate is taxed at up to 28% on capital gains. So it just sort of juices the numbers a little bit here. But if those were shares or some other class of asset, then potentially that number is 20%. So the investor decides to split that gain between an SEIS qualifying company B in this case, and an EIS qualifying company A, 50,000 into each of them. And on the right here, you see what the immediate tax effects of that are. So the 50,000 that goes into the EIS qualifying company grants him a £15,000 income tax relief. That's the 30% in the year of investment. So that's this tax year. He would claim that through self-assessment. That number is 50% for SEIS. And then below we see what happens with capital gains. There's no reinvestment relief on the EIS shares, but those gains are deferred. And there's a further £7,000 of benefit for the SEIS shares because half of the gain is exempted. So we get a £7,000 benefit on that. So at the bottom, you see the net investment cost. Disregarding the gains deferral, because those will be revived ultimately. The £50,000 investment into company A costs him 35,000, and the £50,000 into company B costs 18,000. So again, immediately, you've taken a lot of risk off the table by those tax rebates and benefits in year one. But it gets even better than that. So if we look at the returns at the end of this, so these are the EIS shares. This time we're looking at 3 examples here. So break even in the middle. Even if that investment only returns its money, then your investor's made £15,000 of profit, because as long as he holds the shares for 3 years, he gets to keep that £15,000 of income tax that was credited to him in year one. Contrast unapproved shares, and that obviously would be a 0. But in the case of a total loss, things are it also better for the EIS investor than unapproved shares. In the event of a total loss, you get loss relief on income tax rates on that £35,000. So that's the 50 minus the tax rebate in year one. And so the net loss is that £19,000 there, compared to potentially 50,000 for unapproved shares, depending on, there's a number of variables there as to whether that's 50 or 20, as low as 27.5, depending on the quality of those shares and whether the individual has losses they can set off, gains they can set off those losses against. Let's take a more positive look here. If let's say the investment returns 3 times its money, then the net profit is 115. Again, you still get to take the benefit of that £15,000 of income tax you got in year one. So your net cost is 35. Your gross profit is 115, and because there's no tax on that, your net profit is also 115. Compared to unapproved shares, where that result might be 80 to 90,000. 80,000, assuming 20% taxes, 90,000 if business asset relief applies to that, which is possible. But nonetheless, in all cases here, you can see that the EIS shareholder is better off, regardless of the outcome of the investment compared to an unapproved investor. Looking at the SEIS shares. Again, same 3 examples. I don't want to labor the point going into the detail, but I think the difference is quite stark here. And looking at the 3x return example, I mean, you can see that's a very significant difference between 80 and 132,000 there. And again, in the total loss situation, taking into consideration the income tax relief, the exemption on 50% of the gain that was rolled into the investment, the loss relief on exit, he's lost £50,000 worth of shares, but the net cost to this investor is less than £7,000. So that's where we get to that 86.5% downside protection. It's very attractive from that perspective. So maybe I'll just pause there. Are there any questions on the kind of the preamble before we dive a little bit into the qualifying criteria and the remainder of the presentation? Resounding silence. I'll take that as a no. I'll carry on. But again, feel free just to dive in if there are any questions. So the qualifying criteria divide broadly into the qualifying criteria for the company and the qualifying criteria for the investor. Given the extent of the tax advantages that are on offer here, it's important to note HMRC takes a pretty strict line on these qualifying criteria. They expect, these regimes are expensive for the taxpayer. The Treasury effectively is subsidizing investment in private companies. There are good policy reasons for that. attracting investment into startups and scale-up businesses in the UK is something that has been a policy aim for successive governments for a number of years. But they don't want it to be abused. They want to make sure that these are really only being used by those companies that meet the specified criteria. So generally speaking, we're talking about companies that are UK resident or that are resident overseas but have a permanent establishment in the UK. So really we're looking at UK businesses here. They're not to be listed on a recognized stock exchange, but that oddly excludes the AIM market. So you do find that there are sometimes AIM-listed shares that are available in the EIS and SEIS markets. More likely EIS than SEIS, given the size we're talking about. And they must not be time-limited SPVs, so not for the sake of a single investment. They're intended to be, the purpose of the regimes is to incentivize investment, to provide effectively runway for businesses to grow for the long term. So they're looking at, building a business that will be profitable over the long term, not something that invests in, something that's only intended to live for 5 years. The funds must be used within 2 years or 3 years for SEIS for the purpose of advancing what they call a qualifying trade. We'll come to what that means on the next slide. There are restrictions on the age of, I say the age of the company, it's actually strictly the age of the trade, although those two things are generally interchangeable. You'll see 7 years for an SEIS investment round, 3 years for SEIS. This is one of the changes I mentioned actually earlier in the call. That was 2 years until 2023. That was a 2-year limit. The SEIS qualifying criteria have been slightly relaxed over the last, in the last 12 months. So that's now 3 years. There are references here to knowledge-intensive companies. I'll come back to that in a moment. But again, the intention is to provide a slightly more generous set of criteria for what they call knowledge-intensive companies. Excuse me. Size of the company, there are limits on the number of staff, 250 for EIS companies, 25 for SEIS. There are limits on the gross assets, again, 15 million and 350. And then there's a financial cap on the total amount that can be raised both in a 12-month period and in the aggregate over the life of the business for EIS and SEIS. They're shown on the screen there as well. Independence, company, you can't raise SEIS or EIS equity in a company that's a subsidiary of another one. It has to be effectively the top company in the group. It can have subsidiaries. They also need to meet criteria around what they're doing, and the group as a whole needs to meet this restriction of having a qualifying trade. And the last point there is about risk to capital. There was a tightening of the rules in 2018 because there were some schemes being offered which effectively allowed investors to subscribe some equity into a company, have very limited downside risk, and claim these tax advantages, and effectively have more or less a guarantee of at least getting their money back after 3 years, which clearly is not in the spirit of what's intended here. So now there is a requirement that really, excuse me, the company has to use the funds for growth and development for long-term profit, and the investor's capital must genuinely be at risk. In other words, there's a real risk that you get back less than you put in, or in fact that the company goes, or that the investment goes to zero. In practical terms, that means that the shares must not have any kind of preference over ordinary shares. There's not to be any call options granted over them, or put options, granted over them to the investor to sell them back at a pre-agreed price. No kind of pre-agreed exits or guarantees written by the founders. There's anything which would allow the investor a safety blanket to guarantee them or to give some kind of comfort that they won't lose money is effectively forbidden here. It's pretty strict, but to be honest, for the issuing companies, perhaps not as bad as it might sound. I mean, it means that you don't have this sort of US venture capital-like market where US VCs will extract very, very demanding terms from target companies in terms of liquidation preference, in terms of really underwriting their rights to be paid out first. And that just doesn't exist in the UK, at least in these tax favored environments, because of these risk to capital restrictions. Okay, so qualifying trade. Most, let's say, ordinary trading activity will qualify. It doesn't mean trading, you need to be selling widgets right now and making money day one. You can be doing things that are preparatory to a trade. It can be research and development that's expected to lead to some kind of qualifying trade. Really, if you think about a trading company in kind of the ordinary sense of the words, it probably qualifies. There are specific exclusions that are listed here. Professional services are generally excluded. Certain property-related businesses are excluded. Certain natural resources businesses are excluded. And IP holding companies are excluded. But broadly speaking, most sort of ordinary trading is going to qualify. You can have a small amount of non-qualifying activity, but it's got to be less than a substantial part. That hasn't been formally defined, but is kind of generally taken to be up, not more than 20% of non-qualifying activities or excluded activities. This just dives a bit more into the risk to capital point I made. I mean, I don't want to repeat myself here, but really just to reiterate the point, it's about using the capital for long-term growth. It goes to the use of funds. So what are we doing with the money? Buying assets, increasing plant, increasing headcount, advertising, marketing, all of those things are great. But if you were to take, EIS funds and use it to buy a warehouse and just sit on it and rent it out, that's not going to qualify as capital for long-term growth, simply because there isn't the risk to investors' capital that's expected. It's deliberately very vague as to how this is worded, precisely because they don't want people like me to come along and game the system with schemes that pay lip service to the letter of the law but don't really respect the spirit. So it's it's pretty broad, and they've deliberately not put really clear rails around what qualifies and what doesn't. But again, there's kind of a common sense prevails approach here. Right, so we've talked about the qualifying criteria for the company. There are also restrictions around who, as an individual, is eligible for this. So preface this by saying the tax advantages here are really targeted at UK resident individuals. As a corporate investor, it doesn't make sense. You can't hold EIS or SEIS shares as a corporate investor. You don't get any of the tax advantages because they're individual taxes that are saved. As a non-resident, you can, and there are some cases where you might like to. For example, if I'm non-resident now, I'm in Australia. If I were to invest in a UK company today, I'm not going to be able to take advantage of the income tax benefit because I don't have a UK income tax bill against which to set off my my credit. But if I were to move back to the UK in 5 years' time, still holding my shares, I would want to know that I can sell them and claim the exemption from capital gains tax. So there are some sort of edge case circumstances where a non-resident investor will look to receive EIS or SEIS shares, but really it is an edge case. For the most part, this is something that's attractive and interesting to UK resident individuals. How much can they invest? Again, the number went up for SEIS. It was previously 100,000. It's now 200,000. This is annual. You can carry back up to 1 year. So you can take income from last year and set it off against this year's allowance effectively. EIS, that number is £1 million per year, but 2 million for knowledge-intensive companies. There is a minimum holding period for both sets of investments of 3 years. We've talked about independence for the company. There's also an independence requirement for the individual. So you're not allowed to subscribe for EIS shares or SEIS shares if you are an employee, or let's say the spouse or a close relation. So that means parents, children, brothers and sisters of the of somebody who's a director or employee of the company. You can be an unpaid director. So that was a relaxation that was brought in reasonably early in the scheme with EIS. to allow effectively venture capitalists or angel investors to come in and take a seat on the board. They can receive limited remuneration, but they're not allowed to be executives, so they can't be effectively involved in the day-to-day management of the business. They can sit on the board, and they can receive kind of reasonable compensation for that, but they're not allowed to be active employees or directors, let's say, of the business. And then there's a concentration limit. So you're not allowed to hold more than 30% of a company that is issuing EIS or SEIS equity. When you're counting that, you have to aggregate, again, aggregating spouses, you aggregate parents and children as well. So you can look at the family unit effectively. And you're not just counting the tax favored equity, you're also going to count the SEIS, EIS, non-favored, all of the shares of the company that you might hold, all need to be counted together. And if you're over 30%, then you're not allowed to subscribe. Okay. So we'll talk a little bit about the practicalities of how these shares are issued. There's this concept of advance assurance. You can write to HMRC and obtain confirmation from them, or comfort from them, let's say, that they agree that you meet all of these various qualifying criteria, that your trade is acceptable, that your planned use of funds is acceptable, that the age of the trade meets the criteria, all of those things. It's not mandatory. We always recommend that clients do it for a couple of reasons. First of all, some investors will demand it. They're not going to invest if they're not going to get their tax advantages, and they're not going to take the risk that they make the investment without advance assurance, and then they get a surprise saying, sorry, it's been declined after the fact. So they will expect it. It's a great marketing tool, even if investors aren't demanding it, to be able to go out to potential investors and say, look, here's what we're looking for. Here's how we're going to spend your money. We're serious about this, and we've gone to HMRC already. We've obtained advance assurance, confirming that SEIS or EIS or both, whatever, will apply to this investment round. It doesn't take too long. I mean, generally speaking, these investment rounds are planned out months in advance. There are cases where it might be shorter, but generally speaking, you're talking about 4 to 6 weeks to get an advance assurance application approved. And the last point here, you kind of need to do the work anyway. You need to provide this documentation either in order to get advance assurance, in which case when you've issued the shares and you go to get your certificate saying these are EIS qualifying shares, here you go, investor, you can get your tax back. If you've got the advance assurance, all you do is attach the advance assurance and say this has been approved in advance. Nothing's changed, essentially. If you haven't got advance assurance, you need to go through this process of providing all of the information anyway. So really, the saving of not getting advance assurance in terms of time spent, you're just really deferring something you have to do anyway. There's a small incremental amount of work involved. On the right side there, you see the list of some of the documentation that's required. It's pretty exhaustive. It's pretty extensive, I should say. As I mentioned, the HMRC takes a pretty strict approach to this. They're quite rigorous with reviewing these applications. They expect to see a clear plan for how the funds are going to be used. They expect to see, financial statements. They expect to see details of the trade, a prospectus that's being presented to investors. Really, all of this supporting information that satisfies them that you're genuinely commercially meeting the criteria, and that this isn't some scheme just to raise the funds and get the tax advantage. So they're pretty rigorous here. They will come back with questions if there's insufficient information presented. Again, our approach is always to provide a pretty strong set of documentation at the front end, and I think we've had a pretty good track record of not having too many onerous questions come back, which again speeds up the process. If you've got to wait for questions to go back and forth, and then it can slow things down inevitably. So then after issuance, you have to file an EIS1 for EIS shares or an SEIS1 for SEIS shares. You've got 2 years to do so, but you can't do so until at least 4 months after starting the trade. So if you're raising funds for a completely blank sheet, not having done anything yet, you need to wait for 4 months. You don't have to do it straight away, but most issuers will do it as soon as they can, because the investors are usually breathing down your neck to say, hey, where's my certificate? I want to claim my tax back. They don't want to wait two years plus to be able to do that. They want to claim it in this tax year. So generally speaking, this is something that issuers will do right after issuance or right at the end of that 4-month period if they need to wait for that. So all being well, HMRC receives these documents. They send back EIS3 or SEIS3 certificates, and those are the actual certificates that you present to your investors saying, okay, here you go, take that, stick it on your tax return, and you get to claim the income tax rebate. All straightforward. A few notes on some, let's say, gotchas that have come up for clients in the past that we want to make sure you avoid, and then we'll have some time for questions. So there is a restriction in the legislation that says that shares must be subscribed in cash and fully paid. So what does that mean? It means you need to take cash from your investors, which sounds very simple, but it means you can't take assets, in lieu of cash. You can't accept cryptocurrency payments. You can't accept other non-cash consideration. You can't accept services and give qualifying shares in consideration for services. And you can't issue EIS or SEIS qualifying shares in satisfaction of a debt, which raises some questions, right? What happens if your investor wants to make £50,000 investment into SEIS shares, and you're going to issue the shares on the 1st of August. They send you their check on today, 30th of July. Is that a problem? Is that a debt? Are you setting off shares for debt? It's not, so long as you take a few precautions. So generally, you'd want something called an advanced subscription agreement that says that any money you give me is not redeemable, it's not refundable, there's no interest paid on that. You don't have any debt-like investor protections, and you do all of this within 6 months, which, to be honest, is a pretty long period in this situation. But provided you meet all of those criteria, HMRC isn't in the business of saying, well, you got this cash, a week before you issued the shares, so we're not going to treat it as a cash subscribed in cash at subscription, right? There is some latitude there. They understand that investors tend to send funds a little bit ahead of time. However, we do need to be quite careful about the ordering of events, both in terms of this subscribing cash and fully paid, and in terms of the order of EIS, SEIS, and ordinary shares if there's a round that comprises multiple classes. If you want to raise £500,000, you can't do that all with SEIS shares, even if you're within the 3-year period, even if your current assets are below the threshold and so on. You can't issue SEIS shares if you've already issued any EIS shares at all, ever. And you can't do it even on the same day. So if you're going to raise a round of 200,000 or 250,000 of SEIS shares, or 200,000, sorry, in 1 year, of SEIS shares, and the balance, the 300,000 in EIS shares, you must do that on consecutive days, at least on consecutive days. So you take your SEIS money today, your EIS money tomorrow. Otherwise, and we've seen this, not my client, fortunately, but we've seen this with, there are examples of this in the market where issuers have issued EIS and SEIS shares on the same day, and they've been denied the tax benefit on SEIS because they issued the EIS, even though it was done technically an hour later. It doesn't matter. It's on the same day. It doesn't qualify. So the SEIS was denied. So timing of events is critical, is the punchline there. And then just some thoughts on general practicalities. We've talked about advance assurance. Again, it's not mandatory, but generally expected or often expected by investors. Leaving enough time to get that done is always recommended. And in that spirit, don't underestimate the length of time it takes to gather up all of those documents to support that application, the business plan, the finances, the proposed use of funds, the investor deck that's being presented to investors. HMRC expects to see all of that, and they expect it to be pretty comprehensive. No hiding anything from them. You're likely to get denied if they come back with questions and you don't answer them properly and comprehensively. Even after advance assurance or approval after issuance is granted, HMRC can withdraw that if it transpires that you've withheld something from them that was material to the application. So full cards on the table is always the best approach here. There's no right of appeal. So if they reject it, then that's it, it's done. So getting it right first time is critical. And we've talked about mixed rounds, SEIS and EIS, timing of those events. Just as a general statement, I would say if you're going to issue any non-tax favored equity, technically you can do it first. You can issue regular shares today and SEIS tomorrow. That's not a problem. But do be aware of the gross asset limit. You may not issue any SEIS shares if your gross assets are more than £350,000 pre-issuance. You ignore any advance subscriptions for SEIS for the purpose of testing that, but you don't ignore any subscriptions for other equity. So if you issue £500,000 of non-tax favored regular equity today, you're prohibited from issuing SEIS tomorrow. You do it the other way around and there's no problem. So just, again, ordering of events is really quite critical. All right. That brings us to the end of the health warnings and the end of the presentation. Happy to take any questions, or do feel free to drop me an email if anything in here sparked any thoughts. Thank you.